Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is Yahoo Finance's Brooke DiPalma, who's here to ask the questions that matter and to keep us from flying off into acronym alphabet soup. And today we're going to be diving into that one big, beautiful bill that just passed, and it's what it's going to be bringing to the economy and adding to the deficit as well. And speaking of the economy, we're steering into a cross-current of slowing growth and sticky prices. That leads directly to our word of the day, which is the dreaded S word, stagflation. The good news, our guest says it is not looking like the 1970s style with the capital S. And this episode is brought to you by the number $5.9 trillion. That's the combined tax cuts and new spending packaged into the OBBBA. That's what I'm calling it. While proponents say it's here to supercharge investment in America, why it could also blow a hole in the federal ledger. And today we are welcoming Christopher J. Wolfe, President and Chief Investment Officer at Pennington Partners Co. He is a 30-year market strategist who's guided billions across stocks, bonds, crypto, and real estate assets. Chris is known for turning complex macro and tax policy into clear, actionable trades. And Chris, thank you for joining us here today.
Thank you.
Before we dig into our word of the day here, stagflation, just give us an overview of where we are in the economy and the markets.
I think the big picture's got a couple of features. The first feature is what's being revealed as a persistence in the inflation data, which is kind of transforming from services to goods. And that kind of rotation in inflation makes it a bit stickier and more stubborn, not the kind of expectations for inflation to come down to 1.5% or 2% and give the Fed a lot more room. That inflation rotation is probably going to keep the Fed on guard. We wrote a piece about this earlier in the year and think that the Fed probably only has 2 cuts this year at best because of that inflation rotation. The other piece of the puzzle, though, is that growth is just kind of tempering down to a lower rate. By the way, small s stagflation gets this more stubborn inflation because it rotates and a little bit weaker growth. And so that's not 70s style, but it's likely to be a conundrum for the Fed because how far do you want to cut? We're not getting that much growth, and there's so much stimulus coming down the road in the next 18 months that the opportunity really is to see how that evolves. But I expect the rest of this year to be just like this with slowing growth and persistent inflation.
Excellent segue into the rest of the show. And so let's get to our word of the day, which is stagflation. Stagflation is an economic condition featuring low economic growth, high inflation, and also high unemployment, all at the same time. And as we were just saying, this is something that we saw in spades in the 1970s. And I think it gave stagflation a bad name. Can we say that?
It is a bad thing, though.
I'm old enough to remember the gas lines. I was only a little toddler, but I remember mile-long gas lines from the situation. Tell us why it's not exactly like that right now.
Yeah, I think a couple of things. First is recounting the 1970s has to recount a number of policy errors, a lot of kind of do this, do that, change this, change that, I think created uncertainty. And I think for folks investing in this environment an uncertainty created I'm going to sit and wait. That's number one. Number two, you had external shocks. You had oil prices moving in ways that were wildly unexpected to your gas lines, and going through the roof meant that you consumed people's budgets to a greater degree. So the consumer really felt the brunt of the stagflation story. I think what has been learned since then are a couple things. The first is that an overreactive Fed of policy of kind of stimulating the economy through lower interest rates is probably not the best thing to deal with stagflation. A patient and more thoughtful approach is number one. Number two is lots of meddling, tinkering with prices and kind of trying to manipulate things, and also not a great solution. And thankfully, we're not seeing any of that. I think the third piece, and this is probably the more important one, is that you can design fiscal policy that's more business-centric to try to pull through, a stagflation or a low-growth, higher, stubborn inflation environment. And in some ways, that's what the OBBBA is meant to do, is just drive a lot of investment, get the corporate kind of engines spinning so that it should translate into some elements of employment. There's some benefits around that. We'll touch on that. But those are the big three things. And that was not present in the 1970s, but is present today.
And I think there's a lot of fear right now based on the companies that I've been talking about, say a Nike or others, that there's going to be this hit from tariffs. And the fear is that it'll be too late then. So how do you sort of address that fear right now?
You know what? First of all, I think the fear is a little overdone. And I don't want to be like, overly cheerleader bullish, but the reality is some interesting things are going to happen. So let me give you 2 big points. The first is, think of it as kind of a 2-stage regime. The first regime is all about what's going to happen in the next 3 years. And there's likely to be a lot of investment. The second is what happens after 2028. And that's the challenge around deficits and spending. And, the lesson that will get relearned around whether or not trickle-down economics works. It doesn't really, but there are some things that we can touch on. I think the other piece of the puzzle in terms of the fear is that when you look at how companies are likely to respond for this, I think the fear is a little misplaced. If you think about it, I used this reference a little earlier, the market and corporates are behaving a little bit like the Brady Bunch. So the 70s show, just to pick up on stagflation. Remember Jan saying, Marsha, Marsha, Marsha?
Yeah.
What was she really saying is like, I want some attention on me.
Yeah.
But that's investors, right? What are they looking for? Margin, margin, margin. So corporate profit margins in the U.S. are astoundingly high. The subsequent return on invested capital has been great. We're a great place to invest. But the reality is if companies want to maintain margin going forward, in a lower growth and a kind of stubborn rotating inflation environment, I think what's going to happen, particularly on the back of this one big beautiful bill act, is you're going to get a lot more investment in AI. Markets kind of suss this out, but in one way, it's not great. It's a little bit like robots for people. In another way, it's like, well, if you're an investor, this is a margin preserving story. Here's the other piece of the puzzle I think people miss. Tariffs aren't like a univariate thing. They hit different ways, number one. Number two, there are all sorts of exemptions and exclusions. For the first time tariffs went out, they might or might not have been politically motivated, but the reality is exemptions and exclusions do apply. And I think the third piece of the puzzle is that if you go back to 2022 and you look at the fuel surcharges during COVID, there was a line item like on the bill that said, if you're rail shipping, whatever, extra $10,000 for fuel, whatever it was. But those things weren't always passed on. Not all transportation companies passed all fuel costs on. They absorbed some, they sent some along. So this idea that it's binary, all tariffs are going to smack us with inflation, or you're never going to get it and we're going to crush margin, it's in the middle somewhere. And the evolution of that, I think, will be determined by how quickly are you going to be investing in AI. Because the faster you can invest, the more you can absorb, the more you might preserve your market share by not raising prices on consumers. So I think we're in the beginning of this loop, which starts for now.
That's a great rundown for us. And let me just kind of follow up on that. How would you be investing in AI right now? Are you concerned that it's just become this go-to safety trade because there's maybe not a lot else out there? You're talking about margins getting squeezed. That's maybe a story that plays out over the following quarters. But how do you play the AI trade?
I'm going to recount where we were with fiber optic cable in 1998 and 2000.
It was a huge build out and we ended up with too much.
I just got fiber to my house last year. So, 20 years later. So look, I think it's a little overblown in the way you look at the Mag 7 and kind of the companies that are using AI and the tools that are out there, particularly relative to energy density and kind of the way that investors are considering its usage, the whole robots for people. I suspect that actually the real beneficiaries are going to be all the corporates that adopt it first and think about it. So there are 2 places where there has been historically very high degrees of innovation. Interestingly enough, number one is finance.
Yeah.
And the reason
you
for
don't
it
think
is,
about that a lot, do you?
No, but it's one of the most innovative places over the last 25 years because of all the rule changes and responsibility. You had Basel III, you had now you have less regulation.
Starting with Sarbanes-Oxley back in the day.
Oh my God, all the way back to the early 2000s. Glass-Steagall before that, when that was lifted, there was an immediate response. The financial sector is incredibly innovative. So one interesting way to think about a lower growth environment, but a yield curve that maybe softens a bit is you're going to see lots of innovation, I think, flow through and maybe to the accruing benefit to shareholders in the finance sector. That would be one way I would look at it. I think that's a margin sustaining story.
Real quick, do you look for an industry leader like a big bulge bank and that they're going to do these bolt-on additions? Or do you look for that smaller fintech company and try to play that in terms of an AI buyout?
Let me be clear. It's not. I don't think it's buy the whole sector. It's more the big firms that have the capital to spend on it for all the dollars they're not going to spend on, privacy and security, data security. But the next piece is on AI and ultimately how it's going to be used to enhance productivity activity in that space. I think that's first. The smaller fintech shops, I think that's more of a venture answer. And interestingly enough, that ties to the One Big Beautiful Bill. There's a whole change in the tax code around Section 1202, and that relates to qualified small business stock and kind of the exemption from federal tax that could be very interesting. I think you'll spur a fair bit of investment in software type companies that would benefit from this type of exclusion. And I would see a lot of opportunity on that front too. So it's the big ones and maybe some of the private ones. I think the regionals probably still have have a lot of wood to chop with respect to getting more productive. And it may actually drive more M&A in this space.
Yeah, and to bring it back to what we heard essentially this week is that AMD and Supermicron, they got a bit of a hit. It seems like investors already baked in what exactly they're bringing to the table with AI. They want more. Do you think that these big players essentially can bring more to the table when trying to compete with NVIDIA?
Expectations high.
Expectations are so high.
So I'm going to go back. I actually think in some ways it's likely to be met. And for the reasons we talked about with that loop, if you're about margin next year and you're looking at a slow...
I'm always going to hear the Brady Bunch now. In my head. Marsha.
You can see the show, right? Her glasses. And she's just a Marsha. Anyway, so I think that the expectations can be met. You've seen growth numbers that show up when companies report their earnings and their sales. Like, we didn't just beat by a little. We beat by 5x.
Yeah.
Wait,
earnings growth right now is outpacing.
Low base, but astronomical kind of numbers. So that typically follows a curve and it will slow down. But at the pace that we're seeing, and given the opportunity set is not just US, it's global, I think it can be sustained into next year. So I'm not super concerned about some of the tech space meeting the earnings expectations going into next year, maybe a little bit of the margin compression for them, because I think it's really about deployment, which I think is set to accelerate, particularly for the things that we're talking about.
All right, we need to take a very short break, but coming up, we're going to be talking about investing in America and a Rev Your Engines runway showdown, not for the faint of heart. Stay tuned. This episode is brought to you by the number $5.9 trillion. That eye-watering sum is the total tax cuts and spending increases packed into the One Big Beautiful Bill Act, and that's according to the Committee for a Responsible Federal Budget. They estimate it will add more than $5.5 trillion to the national debt through 2034. What has been promised is massive investment in America, and this ties into what we've been talking about here, trying to get over that low growth hump. And how do you think it plays out?
I think it plays out with a little bit of an acceleration in growth. I mean, look, there's a economics 101 answer in all of that, and that is people respond to incentives. And so the idea that the incentives, which are, really at the corporate level, from a tax perspective, a really big deal, from Section 179 expensing to expensing depreciation, R&D, you name it, there's a lot of incentives to create investment. And with companies with big margins and cash flow, why wouldn't you do that? Now, there's some other things in the bill that aren't that great, but the reality is the desire to pull investment through the system is so high and very centered that if you took all the other effects, and I'm not saying they're good, but took all the other effects and just focused on the economics, in a very simple way, it is very much, we're paying you a lot to invest here, and it's going to be good.
It's definitely big.
So if you break down the solo equation, right, for GDP growth, government spending, consumer spending, corporate investment, and then
we'll put that
exports.
On the screen,
Okay, this is C plus I plus G, all that. You learned that in school.
Yeah.
So the C part, I mean, the business investment part, that I number, that's going to be growing, I think, meaningfully as you go into 2026, and that will provide a boost. I think one that is probably sustainable throughout the next couple of years. I think the challenge is that's going to be met with the interest rate story and the cost of capital and how that will work out. So what we really need is a low and stable interest rate environment, inflation not to keep rotating higher, but to kind of take a breather, at the 2.5, 3 range and just stay put for a while so that the rates can stabilize. A combination of low rates, cost of capital, and big investment incentives, that's pretty powerful.
Yeah, and what you said before, you said the key date is 2028. Of course, that's when Trump's term ends. And the number one question that I've been getting from people that I've been chatting with is all these investments are being announced, but the reality of them actually getting made by the time we have a new administration is kind of unlikely. So how does that all work?
I think this is going to end up being mostly a private investment function, mostly. And that has to do with a couple of things. Some of the features of the bill include, the re-updating of qualified opportunity zones, qualified, rural opportunity zones now to rehab kind of the rural part of the country. I mentioned the section 1202, the qualified small business, the expensing. All of these things are about corporate investment, I think, in the very near term. And a lot of the benefits start, some are retroactive, but a lot of them will start right next year. And if you know anything about how the corporate cycle works, there's usually a budget flush that comes towards the end of the year. What are we gearing up for in 2026? I could anticipate that being something where you see more direct investment and some combination of, AI, tech, and actually what incentives can we benefit from? It could be as simple as, do we need a plane? Because now that's expensive. Or as, hey, we need to build a new data center because this is really where our growth is going to be. So I can see that kind of investment coming through. On the business side, that's the strong point. I think the challenge around the consumer point could be very interesting. Part of the tax cuts that seem to be flowing through, at least for the consumer base, they're mostly towards the high end. And that's where actually most of the consumption is. But there are some benefits for, the different income strata, particularly some of the lower ones. So the ability to sustain some level of consumption, I think, is also going to be present for the next couple of years. But as we mentioned, I think it's a two-regime environment. The regime between now and 2028 looks good for investing, and some of the programs will continue. I think the real estate ones, the qualified opportunity zones and rural opportunity zones are such a good thing in a lot of good ways that I think that will last regardless of what happens in 2028.
To the next administration.
But the next administration is going to be faced with gigantic amounts of debt and, some form of crowding out. You're going to have something like, if interest rates just stay put, 15% of the budget just in interest payments.
I want to ask you about a different regime here, and this ties back to the word of the day and everything we've been talking about, stagflation here, which is the interest rate side, because we're going to get we're not going to have Chair Powell next year. We know that for sure. Maybe a little sooner, who knows? But there could be lower interest rates than we would have had otherwise. And this gets back to the inflation and that rotating cycle that you said between services and goods. And what if it doesn't necessarily rotate, but they both go up? What then?
Then the Fed is in a very delicate and tricky spot, particularly if the Fed's focus on the short run and kind of reducing the cost of capital is to keep the front end of the curve, which it has a bit more control over through the Fed funds rate, lower. You could see a very steep yield curve because at that point, the 10-year or 30-year bonds would actually move out quite a bit because if both are going up, the bond market's got to reprice that. And that's actually a fear. What the stock market probably can't handle is a 10-year at 6.5%, something like that. And by the time you're over 7, something else has gone on. I do think it's important that the Fed's independence is maintained because that affects the credibility of the dollar. And here's a way to think about it. So if you go back to 1987, we had a Secretary of the Treasury.
Different accords, yes.
We had currency management. But we had a Secretary of the Treasury who said one thing, James Baker, so we like a strong dollar. We had a chair of the Federal Reserve, Alan Greenspan, very new at the time, who said something else in a Business Week article in the weekend of, October 18th. Maybe we should kind of let currencies move a little bit. That cross-up resulted in a lot of things happening very quickly, particularly for foreign investors who said, hey, wait a second, you're going to devalue what I own, which is a lot of treasuries, which is basically from the Middle East at the time. So why is that important? It's because the credibility around policy consistency and kind of what is it we're trying to do, I think is absolutely critical. And so that alignment, I think, is going to be necessary between the administration and ultimately the positions that are taken. And we really, I think, as the United States, we benefit from a strong dollar in so many ways.
Yeah.
All right, we want to get to our runway showdown because on today's Who Wore It Better, we have a classic high-octane showdown, but with two different speeds. It's the cash engine versus nitro-charged leverage. On the left catwalk, we have the chopper cruiser, dividend-rich industrials and defense titans. It comes to a stop in idles with a low, confident rumble, running on free cash flow and fresh OBBBA tax breaks. On the right runway, we have the cigarette powerboat, leverage growth plays from a high beta disruption to crypto. It roars in at full throttle, thirsty for more cheap capital and market momentum. Will investors favor the steady torque that handles any macro road, or will they chase the raw speed that leaves a giant foaming wake? What say you, Chris?
Boats win in the short run, but in the long run, it's the industrials.
Gotcha. So I want to go back to our prior discussion here. I was I was asking you about the Fed, but I wanted to get back to, I wanted to ask you about tokenization because we haven't really talked about crypto yet.
Yeah.
It seems like there's a new access to the markets that bypasses traditional equity capital markets, which is stocks, and debt capital markets, which is bonds. And you combine that with lower regulatory burdens on businesses. It seems like there are channels now that could open up through crypto.
Yeah. Well, to your point about tokenization, let's start with kind of two steps back, because this is important. It leads to why would we be talking about tokenization? Why are we talking about different ways to, split shares or get access to capital? It's because we have a dearth of public companies in the United States. We've gone from something like 9,000 in the 90s down to, at least in an investable way.
Wilshire 5,000 only has about 3,000.
Exactly. But that's not great. We need a lot more companies in the public space, would be my humble opinion. I think many of the policymakers agree with that. And the question is, how do you do it? Going public is an expensive, time-consuming process. There's a lot of regulatory issues. There's a lot of kind of, hurdles that were lifted in the last 5 years to, create more private capital starts, but we need more public tradable investments. And I think really that's the big picture for looking at tokenizing all sorts of investments. And given that the technology is to a degree proven, I think there's still some regulatory aspects of kind of taxation and how you think about it. But nonetheless, I think it's a good way to start addressing this issue of, boy, we need a lot more investments. Now, the challenge around that is that if you have a lot more investments available, what happens to market concentration in Mag 7? I suspect that at the margin, there's probably a little bit of pressure there. I don't think
2028 problem. You get the last question here. We got under a minute.
Okay.
With stablecoins, how should investors be thinking about that when they plan out their portfolio for maybe the next 5 years? Is this something that they should price in? Should they have expectations around it? Especially as we hear banks, we hear Walmart even looking to get in on it.
I feel like in the next 3 years are actually pretty good, at least for kind of the crypto space. And I'd be more market focused, as Bitcoin, Ethereum, and a few others, rather than kind of looking at specific coins. There's so much behind the math and the technology and the algorithms that it really takes a lot more work than just, I hope it goes up. And from my perspective, the combination of tokenization and using more stable coins could get us to forms of digital currency that I think would benefit, meaning ease of transactions across not just the consumer sector, but also the corporate sector.
So Zelle is so yesterday.
Zelle has, I think many of them need to adapt.
Okay.
Fintech, bullish on fintech. I think that was one of the things that we're underscoring here. And I really appreciated the discussion here. Stagflation with a lowercase s. We are not repeating the 70s by any stretch, at least just yet. And just thinking about the OBBA, as we're calling it right now, you heard it here first. There's a lot of investment coming back to America right now. How are we going to access that? Well, maybe not through the traditional channels, maybe through tokenization. And so this is just uncharted territory. Underscoring it all, underlying it all is the investment in AI. So, Chris, really want to thank you for being here. Brooke, you as well. And that is a wrap. And be sure you check out all the other episodes of this video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. Be sure to like, leave a comment, and subscribe wherever you get your podcasts. We'll see you next time on Stocks in Translation.